So as I was uploading my the Ink and Grow Rich book, as I was uploading it, I realized that for section 4, there's 3 chapters, and I forgot to upload the last chapter of section 4, which is chapter 3. Nurture a great, lasting, and successful profit and protection-centered relationship with your corporation. This is maybe gonna take me about 30 minutes to read. So, director, officer, employee. Where do you fit in to get maximum benefits? Case study, Fritz. Fritz's grandfather was a printer, his father was a printer, and at age 29, Fritz found himself at the helm of the family corporate business. He started out as young as a boy, helping his dad after school and on weekends. It was good, a viable business. And that kind of makes me think about, like, I wish I had a father who held me by the hand to, like, teach me about the business and work, you know, like my stepfather's dad did, you know. It was a good, viable business. His father made enough money to send Fritz to college to earn a business degree. When he returned from college, fresh-faced and full of ideas, Fritz was amazed at how lax his father had been running the business. His dad was ready to retire, and so at the next board of directors meeting, a unanimous vote confirmed Fritz as the new president. He admittedly felt some resistance from several employees. Maybe it was because he was having all the employees, including himself as president, sign employment contracts detailing their positions, titles, and compensation, or they were disgruntled because he took away everyone's authority to negotiate deals, enter into contracts, or make trades without first receiving board of directors' approval. Fritz knew what a lawsuit-crazy society we live in today and was taking no chances on losing the protection of the corporate veil simply by allowing any employee apparent authority to act on behalf of the corporation. As president, he had to answer to the board of directors, who in turn had to answer to the shareholders. Fritz knew he had better know what was going on throughout the business. So it was like a change of management. Key points. What's best is clearly to define your activities as the director, an officer, and an employee. Any corporate transaction has to be performed by a director, officer, and employee, not by you as an individual. If you and/or your corporation are having difficulty with the law or the IRS, neither you nor your corporation can transfer assets to another entity fraudulently. Even if you are not in trouble with the law or IRS, fraudulent transfers are never a good idea. Shareholders are usually not liable for corporate debts. Shareholders are usually not liable for corporate debts. I need to roll down my window. It's pretty hot. Director, officer, employee. Which are you? Are you all three? How do you keep the activities, duties separate? The number one question is, how do I handle money transactions concerning my corporation? This is my most frequently asked questions. A few typical follow-up questions include: A, should I become an employee of the company and take income as a salary? Should I take profits and dividends as a shareholder? Should I work as an independent contractor to my corporation? These subjects will be addressed separately. However, care must be taken to follow the rules. If you don't, there are ramifications and some consequences you certainly do not want or need. Employee of your corporation. Let's say you formed a corporation. You and perhaps your spouse are its sole shareholders. You and your spouse are the only ones working for the corporation. The ideal situation is to become employees of the corporation rather than operating as independent contractors. Let me explain why. As an employee of the business, you have access to many corporate benefits that are not allowable if you operate as an independent contractor or only show yourself as an officer and director. You must, in fact, be a W-2 wage-earning employee subject to the required payroll tax withholdings, federal, FICA, SSI, medical. Once set up, the ultimate goal is to take a low salary, so only the minimum amount is withheld. You then make up the difference by letting the corporation pay for all those wonderful tax-deductible benefits, such as monthly car allowance, dependent care, health insurance. By letting the corporation pay for all those wonderful tax-deductible benefits, such as monthly car allowance, dependence care, health insurance, medical, dental costs, home office rent, and like. And you can start saving for retirement immediately. Note, since you are an employee of a corporation, your salary will be subject to any state income tax requirements in the state in which you reside. However, this should be minimum because of the salary you took. Salary or dividends. Being the owner of the corporation entitles you to certain rights and preferences. However, you have no voice formally in the day-to-day management of the corporation. Most corporate owners, acting as an employee, W-2 wage earners, take compensation in the forms of salary and benefits. Shit's annoying, huh? In a small or family-owned corporation, the issuance of dividends, income distributions to shareholders is very unlikely, thereby avoiding any double taxation. The board of directors has the sole discretion to determine the amount, cash or stock, which will be paid as dividends. Keep in mind, however, that dividends can only be paid from the net earnings and profits of the corporation. To determine the earnings per share, you divide the net profit by corporate shares outstanding. If there is no profit, dividends cannot be paid. When dividends are paid, they are taxed twice, once at the corporate level and again in the hands of the shareholder. If the board of directors decides not to pay any dividends but reinvest back into the company, these funds are called retained earnings. So let me read this quote. So if the board of directors decides not to pay any dividends but reinvest back into the company, these funds are called retained earnings. Okay, let me read this quote. Definite of purpose can, and it should so completely occupy the mind that one has no time or space in the mind for thoughts of failure. Napoleon Hill. Independent contractor, IC. For yourself, you would be hard-pressed to convince the IRS you're an independent contractor in your own business. The most basic standards for qualification as an independent contractor are not present. You are working under the corporation's directions, not independently. You are working at the corporation's premises, not elsewhere. Even if you were an independent contractor, you would not be eligible to receive any corporate benefits. When do I pay myself? Initially, you will probably serve as the officers and director without any compensation. However, when the corporation has sufficient income to support your salary, then pay it. Then you can begin taking advantage of all the corporate benefits available to you. So when the corporation has sufficient income to support your salary, then pay it. Write your compensation policy. The rule of thumb is to determine your salary and bonus policy at the beginning of the year, formally and in writing. However, it can be determined that compensation is likely to vary based on the corporation's profits. The key is to have a formula that is followed year after year to show consistency in the way compensation is figured based off percentage. Place your spouse and children on the corporate payroll. To take advantage of valuable tax deductions, place your spouse and even your children on the payroll. Of course, they have to actually work in the business, and payroll taxes must be paid regardless of their ages. This enables the corporation to pay money that will be paid. This enables the corporation to pay money that would have been paid at a higher tax rate in salary or dividends and shifts it into your child's tax bracket that starts at 15%. This enables the corporation to pay money that would have been paid at a higher tax rate in salary or dividends and shifts it into your children's tax bracket that starts at 50%. As an employee, your spouse participates in all the tax deduction benefits available through a corporation. With your children as employees, you can begin saving for their college education tax-free. How much can you pay yourself? Yes, you do it all, and as hard as it is to believe, the IRS may deem your salary to be too high. In closely held corporations, the IRS scrutinizes compensation paid to shareholder employees to see if some of it may really be dividends. In closely held corporations, like a small corporation, the IRS scrutinizes compensation paid to shareholder employees to see if some of it may be really dividends. The courts tend to look at all the factors regarding your compensation to determine if the corporation is really getting its money's worth. Are you qualified, education, and experience for the job? How many hours do you work, and what are the duties you perform? What achievements do you have that show the business wouldn't have made it without you? What are key employees paid in similar businesses that offer similar services? So you're going at the market. What's the market? What are key employees paid in similar businesses that offer similar services? A court looks at the size of your company based on sales, net income, or capital value, and the relationship between you and your corporation. The Ninth Circuit Court of Appeals says it will look at a company's return on equity after paying compensation. If that amount satisfies any outside shareholders, then there is a strong indication that profits are being siphoned off as salary. If that amount satisfies any outside shareholders, the Ninth Circuit Court of Appeals says it will look at a company's return on equity after paying compensation. If that amount satisfies any outside shareholders, then there is a strong indication that profits are being siphoned off as salary. Show me the money. There are a variety of avenues to pull money out of the corporation. The goal is to have your corporation spend excess earnings on you. The goal is to have your corporation spend excess earnings on you. The owner or employee has a deduction to your corporation and without tax implications. Note the following avenues to retrieve cash, compensations, and benefits. Profits, dividends. So profits or dividends. Salaries, bonuses, established criteria early in the year based on bonuses. Established criteria early in the year based on sales or increased profits. Loans. Shareholders often lend money initially to the corporation in addition to their capital investment. Leases. Shareholders lease equipment, buildings, real estate to the corporation. Sales of corporate assets. Shareholders sell assets to the corporation. Employee benefit plans. Fringe benefits. Expense accounts. Proper documentation is critical. Remember, the IRS can challenge and disallow claim deductions if they view them as unreasonable. Arm's length transactions. When you operate through a corporation, you have many hats to wear and many roles to play. Any transaction involving you and the corporation must be handled with a great deal of care. Keep in mind that the corporation is a separate legal entity and the board of directors is required to use good faith and judgment. The board owes a duty to all shareholders, not just a majority of them. If the corporation is going to enter into a contract, lease a piece of equipment, or buy a piece of land that ultimately benefits you as an individual, it needs to be handled at arm's length, just like you would if you were doing business with any other person or company. For example, if the corporation is going to buy a piece of property that you own personally, so they're going to buy it from you. So if the corporation is going to buy a piece of property that you own personally, you would set the same terms that would prevail if the parties to the transaction were not related to each other in any way. The transaction should be fair and reasonable, not one-sided. Be sure to maintain a traceable paper trail to prove that all actions were performed by a corporation and not just by individuals. So, you got to do the meetings. You got to have the meetings. The shareholders all got to agree on these purchases and even sales, Fraudulent conveyance, another red flag. A corporation facing financial difficulties cannot simply dispose of its assets in order to avoid paying its creditors without first considering the fraudulent transfer laws. Okay, so a corporation facing financial difficulties cannot simply dispose of its assets in order to avoid paying its creditors without first considering the fraudulent transfer laws. If you are being sued as an individual, you may be tempted to transfer some or all of your assets to your corporation to keep the assets protected. This will ultimately get you in trouble. The courts refer to this type of transaction as fraudulent conveyance. So let's say I own something in my name. And I'm about to be sued. So all this shit that I own, so they can't get it, I just put it into my corporation. That's called fraudulent conveyance. And this term is used to describe any attempt to improperly transfer assets for the purpose of avoiding lawsuits, liens, and the claims of creditors. You should consult with an attorney before making any transfers to determine if such transfers will be considered fraudulent. Now let's read this little quote. The greater the obstacle, the more glory in overcoming it. Molière. Personal guarantees. Certain debts, such as a bank loan or establishing credit with a supplier, which you may incur, require you first sign a personal guarantee as a condition of the transaction. personal guarantee you're going to pay back. This removes any liability insulation for the corporation and instead requires you to pay the obligation in the event the corporation can't. Okay, so personal guarantee. So you're personally guaranteeing, not your corporation, that you as a person, individual, will pay back. Certain debts, such as a bank loan or establishing credit with the supplier, which you may incur, require you first sign a personal guarantee as a condition of the transaction. This removes any liability insulation for the corporation and instead requires you to pay the obligation in the event the corporation can't. While often signing a guarantee cannot be avoided, you should make sure you terminate any outstanding guarantees once credit has been firmly established with your corporation. Or more importantly, if you ever sell your company to someone else. Hot tip, make sure you remove yourself from any personal guarantees because they follow you, not the corporation. So you better make sure you pay it back. Shareholder liability. By limiting their ability to the amount of their investments, shareholders become the economic foundation for encouraging business development and fostering stability in commercial. By limiting their ability to the amount of their investments, shareholders become the economic foundation for encouraging business development and fostering stability in commercial transactions. When a corporation is organized for lawful purposes and treated as a separate legal entity distinct from its owners and absent special circumstances, owners generally are not liable for corporate debts. Shareholders must make it very clear that they are, in fact, operating through a corporation. For example, if you have been operating as a sole proprietor for a period of time and later incorporate the business, you can be held personally liable to creditors that never received construction notice of the corporation and that still believe the business is being operated as a sole proprietor. Or so you gotta let the your creditors know that you're not a sole proprietor no more. The way to avoid this problem is to immediately begin operating in a manner that clearly identifies you as operating as a corporation, featuring your new corporation designation, Inc., Corp., and the like. You do this by printing new letterhead and business cards, by signing contracts and other documents in your capacity as a corporate employee, and by making it very clear that you are acting as an officer of the corporation, whether in person or in paper, by including your corporate title. This will eliminate the appearance that you're acting in an individual capacity. If you as a shareholder, officer, or director undertake activities that breach your duty to the corporation, are negligent, or allow the corporation to engage in unlawful acts, you will be held personally liable. If the state of incorporation has laws that protect the shareholders from personal liability for corporate debts, you must be careful and cognizant of any laws, shareholder liability. In other jurisdictions, if your corporation will be transacting business in another state as a foreign corporation, if the state of incorporation has laws that protect the shareholders from personal liability for corporate debts, you must be careful and cognizant of any laws in other jurisdictions if your corporation will be transacting business in another state as a foreign corporation. How can I be a foreigner if I'm still in the United States? When you incorporate, the state in which you incorporate is the domestic state, and the corporation is a foreign corporation to every other state. If you're intending to conduct business in any other state, the rule is that a foreign corporation must qualify to do business, filing a foreign corporation with the Secretary of the State in that state prior to commencing business, filing as a foreign corporation with the Secretary of State in that state prior to commencing business. There is a traditional statutory test for determining whether a corporation must qualify in a foreign jurisdiction. Transacting business test. There is a traditional statutory test for determining whether a corporation must qualify in a foreign jurisdiction. Many court cases have resulted from lack of a true definition of transacting business. Section 1501 of the Model Business Corporation Act enumerates certain activities that may be conducted by a foreign corporation without it being considered to be transacting business. These are maintaining, defending, or settling any proceeding, holding meetings of the board of directors or shareholders, or carrying on other activities concerning internal corporate affairs, maintaining bank accounts, maintaining offices or agencies for the transfer, exchange, and registration of the corporation's own securities, or maintaining trustees or depositories with respect to those securities, selling through independent contractors, soliciting or obtaining orders, whether by mail or through employees or agents or otherwise, if the orders require acceptance, fulfillment outside the state before they become contracts, creating or acquiring indebtedness, mortgages and security interests in real or personal property, securing or collecting debts or enforcing mortgages, and securing interests in property securing the debts, owning without more real or personal property, owning without more real or personal property, owning without more non-income producing real or personal property, conducting an isolated transaction that is completed within 30 days and that is not one in the course of repeated transactions of a like nature, transacting business in interstate commerce. Generally speaking, most states have adopted the 1984 Revised Model Business Corporation Act in its entirety, and only a few remaining states may have some exceptions. It is suggested that you may contact your Secretary of State's office to request the statutes that govern foreign corporations in your home state. It is suggested that you contact your Secretary of State's office to request the statutes that govern foreign corporations in your home state. It is suggested that you contact your Secretary of State's office to request the statutes that govern, so you can learn how they do, maybe in other states how it works. Most states have adopted the 1984 Revised Model Business Corporation Act in its entirety, and only a few remaining states have some exceptions. Conclusion: even if a corporation oh shit, there's a chapter 4 here that I forgot. So I gotta read chapter 4 too. Conclusion: even if a corporation consists of only one person, the duties and activities of the corporate directors, officers, and